All right, I just pressed record. I think it's recording.
Okay.
Great. All right. So, hi everybody. This is Ari, and I'm here with
April Crossley.
April Crossley. And there's a lot of people that are asking, what are the different ways to invest in real estate? What are different ways you could do it? What's best for me? And everybody that's starting out on their real estate journey is like, these are really valid questions. So, really excited that April decided to team up with me to really talk through a couple different four different types of investing, and we're going to kind of go a little bit in detail. And this is really for people that decided to take the plunge into real estate and don't know necessarily which ones to do. So we're going to do the pros and cons of each approach. We're going to grade the different approaches based on upside, riskiness, the control that you have, and your goals. So we're going to talk about four different ways to invest in real estate, and maybe we'll start out with, there's four, which is sole investor is one, joint venture is the second one. We'll talk about syndications, and then we're going to talk about REITs.
Yep.
So maybe April's going to kick us off.
Kick it off.
The sole investor.
So I've been through all of these except the REIT. And I know we were talking about before we started just how sometimes your strategy changes as you go along. So in the beginning, I started out as a sole investor. It was just me buying properties that I could afford to buy. So we were buying them with private money, but buying single family homes or buying small multifamilies that we could buy cash and then do a cash out refinance. And kind of just doing everything on our own without any other partners. So we didn't own a building with anybody, other than like our private lenders having a lien on it until we did the cash out refinance. So we did the sole investing route. I did that for a long time. Yeah. And we can kind of, I guess, get into the pros and cons of that then.
Okay. So yeah, the pros and cons of sole investor. Well, I think I'll say a couple pros. I mean, you get to really control everything. You get 100% of the profits, which is great.
Yeah.
However, there are some cons.
Yeah. Can be a little exhausting. A little exhausting. And I just think sometimes having a joint venture partner really brings another level of expertise that you don't have, because not everybody knows everything and not everybody has the same strengths. So even looking back, I know even as a sole investor, I've done some joint venturing now with a partner that I'll take on some of my flips. And he has experience with structural issues and some things I would have never, even with apartment buildings, would have never tackled before, because I was like, this is too risky, but he's more knowledgeable than I am with those things. So I feel like the con is probably you only have access to the knowledge that you have, there's not a team of people giving their input on that property. Yeah.
And that it's a little bit harder to scale, right? Because like you're going to run out of money eventually. You're going to run out of you're not going to be able to find deals all the time, and sometimes it's harder to find deals and money, and it's really kind of a different skill set. Of course, there's people that are very good at both things, but like it's a little bit of a different approach in terms of who you're talking to, your audience. Like if you are you're really good at finding those motivated sellers that want to sell their house, they want to get out, help solve their problem. You're talking to them very differently than if you're trying to raise capital. It's kind of like more of a talking to some more professional, I think, or like talking to banks or talking to like angel investors. If you think about like these startups and pitches, like that's a different skill set than talking to somebody who's in a different situation that just wants their problem solved. So I think that if you do it all yourself, you're not gonna it's going to be harder to scale.
Yes, for sure. Your net worth grows a lot slower.
Yeah.
That way I've found. Yeah.
So like the other thing we want to talk about is joint venture and the pros and cons. First, really to, define what the joint venture is. This is when you create a company with a venture with, not a certain amount of people. I think it's got to be less than 10 people, or there are some rules about that. But that's where you can kind of scale, leverage the expertise of another person. Maybe one person finds a deal, the other person gets the money, the other person knows the construction, and you can joint venture on many different types of things. Like You can joint venture on a single family home flip. You can joint venture on a multifamily apartment building and stay in the deal for many years. It can be a short, thing. It can be a longer thing. And that's kind of can be defined through an operating agreement in terms of who has what percentage of the deal, who does what for the deal, who puts how much money in the deal. And that allows you to, scale more and it has more other people involved. But there are pros and cons to that as well. So, for example, a pro could be if it's big enough and you have enough ownership. If your goal is to get to more financial independence, a really good deal could catapult you to financial independence, faster than maybe a sole owner or some of the other things that we're going to talk about, like syndications and REITs. So that's definitely a pro. Are there any other pros you can think of?
For sure. I think it just comes back to not having to have all the pieces together. Just like you said in the beginning, when you joint venture, sometimes people will say to me, I can find the deals, but how do I find the money? And my answer is just find the deals and find the people that know how to find the money. You don't have to have every piece, which is definitely a pro to it, because you can focus on what your strengths are. For some of us, our strengths are finding the money, but not so much finding the deals. So it's a good way to pair people that are bringing different pieces of the puzzle together to allow you all to make money without having to wait till you have all the pieces. You don't need all the pieces. Yeah.
Yep. Now, of course, like with anything else, it does have some cons, right? It's probably going to require more time of you, right? When you compare it to investing in a REIT or a syndication. So you got to put a little more sweat equity, think about it, really do the evaluation and the analysis, because you're a bigger part of it. So it means you have a bigger part of the rewards, but also a bigger part of the risk. So I think that's more kind of like, it's kind of a deeper step in than just being completely passive investor.
Yeah, definitely more hands-on. Yeah.
So that's definitely a con. I'm trying to think of another con, and I've got it here on the sheet. It's it's the risk too, because if you have a bigger ownership percentage and something goes wrong, that's more on you. Obviously, it's not the sole investor. You're not the only person. There's also can be disputes too, with the joint venture partners. I would say, like, versus all four of them, having if you form a joint ventureship and you have a dispute within it, it can be a little bit hairier to, like, okay, I got to do this, I got to find this, I got to speak to a lawyer, I got to do this, versus like, if maybe if you're in a syndication, well, it's the rules are kind of already there. It's more kind of, black and white, and it kind of is what it is. And you have less, less recourse if something happens. If you invest in something and you didn't like XYZ, well, you signed a lot of documentation that says you have a certain limit to what you can do.
Right. It's like, tough luck. You don't like it. Here's how the rules are. That's kind of syndication. And then being a solo investor, you are making all the decisions. So it's like you decide whatever you want to do. But in a joint venture, your partner is sometimes the deal is very important, don't get me wrong, but sometimes the partner you choose is equally, if not more important than the deal, because when push comes to shove, it's going to make it a lot harder for you to get out, a lot harder to liquidate, a lot harder to make decisions, because you have to make them alongside of that partner or partners sometimes. Yeah.
Absolutely. So moving on to syndication. Syndication is, when we should define it for the folks that are on this. The best way to define it, I think, is when you're partnering with an organization or a group of operators that are investing in a property or a business, and you have more of a passive role where you're basically putting in cash, but you have knowledge that it is an investment, it's a risk, and you have all the information and documentation, and it's really on you to, like, choose, whether or not, you want to invest in this, but you don't have any expectation from a time perspective or anything like that. You don't have to do that, and you have you could have an expected return on that, or depending on how the deal is structured.
Mhm.
So a positive of that would be, you could actually do pretty well without having to spend any time at all.
Yeah.
So that's definitely a positive.
Yeah. Yeah. You're also kind of like, I guess, on the negative side, a little, you're giving up that control, and you're also giving up that ability to liquidate your funds. I mean, when you invest in a syndication, it's usually 3, 5, 7, 10 years, something like that. And you're signing off saying, I understand my money is going to this deal for a long period of time. So it's not like you can go back and say 2 years from now, hey, I want my money out. So like give it back to me. And they're going to be like, no, because this is what you committed to. This is the time frame you committed to. So you definitely have less access to just like liquidating your funds that you put into that deal. But again, you don't really have to do any work. I mean, you're reviewing the deal, you're writing a check, you're sending it off, you're collecting a return, and that's pretty much it. So it's nice for people that want to make a good return, but don't really want to do much.
Yeah.
Yeah.
And, you know, and to build a little bit about, like, it depends your goal. Like if you are, a high powered lawyer that has, $500,000 salary or something like that, and don't want to get into the details of real estate, like that's really a really good option, I think. If you are, if you are trying to get to financial independence through real estate, syndication may not be the right choice for you overall for the long term. It could be a good thing as part of what you're doing. You can also invest passively as a syndication, see how it works, see if you like it, and do some other things. But if you kind of do the math, if a lot of syndications are a certain 8% or maybe a 15% IRR or what have you, do the math. If you really want to replace your income, how much capital do you have to put into a syndication? We're talking a lot of money. We're talking,
Yeah.
could be even $1 million or something like that. And many people don't have that type of liquidity. So I would say if your goal is to achieve financial independence, it's going to be a little bit harder if all you do is syndications.
Agree. Yeah.
And then we want to talk a little bit about REITs. So real estate investment trust. So this is basically the most similar to the stock market of all these different options on how you could invest in real estate, because a lot of times you don't know necessarily exactly what is being invested in. You could be in, a mix of, Sunbelt properties, office mixed with some retail and multifamily, and you don't know necessarily exactly what, the property is. But, similar to a stock, it's extremely liquid. So like what April was talking about before, like you are in a syndication for a while, right? And if you're in a joint venture, you can't just up and say, I'm out. It's not as easy to do that. But with a REIT, it's completely liquid. You could sell anytime. Not to say it's going to be worth more than what you bought in at, but you can get out at any time.
Yeah. I've never tiptoed into the REIT space because I always go back to the whole stock market reference. It reminds me of the stock market. I was like, I just feel like I don't have enough control over that. But from keeping your money liquid and having access to that liquidity, I definitely see the pros of it compared to, the long-term syndication investing or the joint venture partner investing.
Yeah, and that's really a big benefit that I think if you think about stocks versus real estate in general, the liquidity is really big, big difference. Stocks are, very liquid, but and REITs were developed, I think, to help counteract that. People that wanted to invest in real estate but wanted the liquidity that stocks brought. I think with technology and there's listings all over the country and you can buy in different states, I think real estate is becoming more liquid in terms of more technology, more advancements. It's not everything's not hyper local. You don't have to wet sign everything on everything. Recently, I did a closing that I didn't have to show up to, and I did everything electronically. That was the first time I ever did that.
That's nice.
But I think, a lot of banks want you to wet sign and they want you to like show up and, say hi. And there's just a lot of paperwork.
Yeah.
But I think real estate, is good. I have a feeling it's going to get more and more liquid because of that. But REIT is basically people want total liquidity. The cons of that is exactly what April said. Like, you don't have that control, and the ups and downs are completely you're much more vulnerable to external shocks like the stock market. Like if you think about COVID-19, REITs got hit right away. Like I think office went down 30%. What is it, like strip malls and stuff like that went down like 20%. And if you were in that, like you're in trouble, and you kind of got to go back. Whereas if you own an office building, you have everything's like hyper local. Like you may have some tenants that said, hey, sorry, we don't like you and we're leaving, or we don't need this space anymore and we're going to challenge the lease and all that. But some people said, hey, we don't need people now, but we're still interested in the lease. It's very kind of local, and you have more control, and it's case by case. Whereas REITs is kind of, it's more the overall market and overall stock market, which is what a lot of people invest in real estate in general. So those are some.
You kind of see the same thing with the syndications too, where you, like with COVID-19, there were some syndications that weren't paying out to their investors because they kind of put payments on hold. So again, you're passively investing and you're not having to do a whole lot of work, but you really don't have a whole lot of control. So like the stuff I own as a solo investor, I mean, if my tenants stopped paying, I wouldn't be getting paid either, but I have a little bit more control in like working with them, working out payment systems. I'm the only one that has to get paid. So it's not like payments stop across the board for everybody. But like you said, with REITs, with syndications during COVID-19, the same thing happened. Like we're invested passively in some, and payments were halted because those owners were trying to set that money aside for tenants that wouldn't be able to pay because they would be laid off from work. So you're susceptible to kind of those ups and downs as a syndication. When it's good, and you're taking part in that. But when there's downside, you're also taking part in that downside as well, unfortunately, sometimes. Yeah.
All right. Well, wanted to thank you guys, everybody, for listening to this. If you stayed this long, it means I think you liked the content that we had. So thanks very much, and thanks so much to April for taking the time to chat. And that's it.
Thanks, Ari.
Thank you. And now, by the way, April, I've never recorded on Zoom. If I press end, it's not going to like die, is it?
It'll just say, you can just hit stop recording.
Okay.
And it'll